Welcome to XYPN Radio, where your host Alan Moore brings you into a community of fee-only financial planners who want to profitably and successfully serve Gen X and Gen Y clients. If you're ready to get the knowledge you need from leaders in your field, learn from forward-thinking advisors, and take action on your own goals, XYPN Radio is the show for you. Here's your host.
Hello and welcome to this episode of XYPN Radio. I'm your host, Alan Moore, and today I'm really excited to have my XYPN co-founder, Michael Kitces, on the show today to talk about a topic that seems to be coming up a lot at conferences, and that topic is fee compression. You know, the robo-advisor technology caused a lot of concern around AUM fee compression, but the recent launches of financial planning services by Vanguard, Schwab, and even Betterment for Advisors has caused advisors to ask the question, are we in a race to zero? We were recently asked if we think advisors need to match Vanguard's fees in order to stay competitive. The short answer is no. The long answer can be found over the next 60 minutes. You can find any of the additional resources that we mentioned during the episode at xyplanningnetwork.com/90. In addition to the typical resources, you'll find a link to our recently launched book, co-authored by Kitces and myself, titled The Monthly Retainer Model: What it is, why it works, and how to implement it in your firm. If you'd like more time to spend with your clients, First Ascent Asset Management can help. First Ascent builds and manages investment portfolios for independent financial advisors and their clients for a flat fee of $500 per account. This industry-first approach to pricing makes professional investment management affordable for everyone without sacrificing quality. First Ascent's 7-member investment committee includes 5 CFAs, a PhD, and a CFP who collectively bring decades of experience, objectivity, and fresh perspectives. First Ascent offers a variety of portfolios designed to produce solid, long-term performance while keeping internal expenses and trading costs low. First Ascent's high-touch service team stands with you as a resource to provide guidance and to make account opening and servicing the accounts easy and hassle-free. They also offer a streamlined technology platform to facilitate proposal generation and paperless account opening. Visit their website at firstascentam.com or give them a call at 720-465-7888. Also be sure to go to xyplanningnetwork.com/VIP to join our private group just for XYPN Radio listeners. You can interact with other listeners, ask us questions, and more. Hey, Michael, welcome back to the show, man.
Thank you, Alan. Good to be back. Good to be on the show again. It's been a couple weeks.
It has been a couple months, potentially, actually.
Well, I think last time I was on was the beginning of January because it was just before we did the Financial Advisor Success podcast launch.
Oh, that's right. So what you may not know is that after that podcast, or maybe the one before, we had a conversation about content. It was that mailbag episode where we talked about structuring our content calendars. And I said that I was just sort of a wing it kind of guy. And I was just sort of willy-nilly about it. And it really stresses everyone out, including our marketing team, who was like, hey, it'd be great if we could get the content more than the day of so that we could build a marketing plan for it. So we're actually 4 weeks out. So we're recording this in mid-February. This actually won't go live until early to mid-March. So
see, and let this be a lesson to everyone that it is possible to expand your team and hire people who can fill in your personal weaknesses.
It's so true. I mean, and tying it back, right? If Jen, our director of marketing, had come in and said hey, Alan, this is stupid. I need this content sooner. I may not have heard her, but when she's like, hey, if we want to market the podcast, we want to, increase listeners and be able to be really good about it. We need the content 3 weeks out. So then I heard it and, it was stressing everybody out. So I finally caved. So we're getting a little further scheduled out. Anyway, so since the last episode, you launched the podcast. So how has podcast launch gone at this point?
Podcast launch has been fantastic. There was an interesting effect that cropped up that I realized, so going back to the days when I originally launched my blog, as many people know, I'm a strong advocate for blogging and content marketing. And I know a lot of people get freaked out about blogging and getting started and what am I going to say? And what if it's not very good early on? And the reality is, hardly anyone really finds your blog when you're first getting started. Google hasn't really found you yet. You haven't really built much of a mailing list yet. I know there's always that scary feeling I'm putting things out on the internet and who's going to find it. But, the truth is not a lot of people find it early on. Some do. And that's part of how you start building a readership and ultimately building business. But it's kind of a low stakes thing. So I go back and look at my early blog posts and They were shorter. They were not as well written. They were not as well organized. I kind of bounced around on topics. I was still finding what I wanted to do with it, but that was okay because there weren't many people reading it, right? Because I was getting started. It was the early days. And, it's only now after I've been doing it for many, many years that there's a lot of people that read it, but I've gotten into a pretty good rhythm. So it struck me when I launched the podcast. So when I was getting started with the podcast, it's like, okay, it's another kind of content thing, and I'm excited. And, I've done some of this stuff with Alan on XYPN radio, so I think I've got kind of a feel for the style and what I want to achieve out of it. And we did the first episode with Rick Kaler, who had this, fantastic story to share about how he's a financial advisor who's, taking home or more than $300,000 out of his practice and living in South Dakota. So I can only presume he lives like a king in South Dakota at that income level. It was like, but he's also nearly declared bankruptcy 6 times in 30 years, going through the ups and downs of his business, and had one point a couple of years ago where 5 of his 6 team members left in a 2-month period. And so it was this really awesome story of just the ups and downs of entrepreneurship and being an advisory firm owner, and how great it can be in the long run, but the challenges along the way. And then we launched the episode, and then like 10,000 people download it in the first 48 or 72 hours. And, there's an interesting effect. So you just publish a podcast out there. You don't even really know that anybody has heard it or listening to it or anything until like you get some web stats, some web metrics that tell you like, hey, people have been downloading this and stuff has been happening. And then maybe you start getting some feedback. But if you imagine that for a moment, so like imagine you've decided to launch a new venture in your business where you're going to interview people. And your first interview ever, you do it in an auditorium with 10,000 audience members. So I didn't realize I had done this to myself until the downloads hit and I saw the stats from the first few days. And then I had this small panic attack about the next 3 or 4 episodes, which at that point I'd already recorded because I was trying to do a few weeks ahead and get into a good rhythm. I was like, oh my God, I don't like episode 3 or 4 or whatever it was. I'm like, I'm not sure I did that very well. Like, oh my God, there's so many people coming to this. And like, it freaked me out a little in a way that I never went through with the blog. Because just when you launch it, it's lower stakes. There aren't as many people there. But when you add, like a second platform or second venue on top of the first, I realized like, okay, like this shit got real really fast when I mentally visioned 10,000 people in an auditorium and then promptly said, I'm never going to vision that in my head again because that's horrifically terrifying. Like even as someone makes much of my career these days as a professional speaker. I mean, I've done audiences of 500 plus, close to 1,000, but I don't know how to wrap my head around 10,000 people. So I'm going to try to never think about that again.
I love it. And that's what I was thinking too, is like, if Michael Kitces, who speaks at almost 70 plus conferences a year, gets freaked out by the thought of people listening to a podcast, like, it's okay for the rest of us to be a little intimidated by it. Because I know there are a lot of folks out there that are considering starting to blog and starting to podcast. And to your point, when you're first starting out, the stakes are a little lower. But, sometimes when you're in that moment, you think like, if your 10 friends and family listen to it, that's everybody that's going to listen to that podcast, and it can feel overwhelming and intimidating. But the truth is, we are all pretty bad when we start out. I'll freely admit that we didn't launch XYPN Radio for a long time because I wanted to take an interview course. I was so concerned about, was I going to be a good interviewer? And like, how the heck do you practice that? And so I was going to find a course on interviewing skills. And I finally just gave up, and it's because I didn't see anything interesting and just gave it a go. But like, and you get better over time. And I mean, I think we're in the episode into our 90s
I love that
now.
Your conclusion to that was like you were going to really build up and prepare, and then you just said, screw it, and did it anyways.
This is launch and see what happens. You'll get better over time. And I figured, hopefully folks have been, and I think they've been generous in coming back and sort of hanging around, see what happens.
But I think there actually is an interesting point there just in the context of building a business and entrepreneurship. And like, the number of advisors that were thinking about starting a firm that I've talked to that were, terrified to do of like, well, what what if I don't know enough? What if I don't have all the answers? I haven't practiced enough or prepared enough or something to that effect. This does kind of make the point. Like, sometimes you just have to jump forward and do it. You can never perfectly answer every possible business contingency that's going to come up. There really is an effect sometimes that running a business is kind of like you're barreling down the tracks on a railroad and you're actually laying the rails off the front of the train as you go. For which I saw a wonderful animated GIF a little ways back. It illustrated it quite well. I think there's an important point there. Don't, take a page from the book of what Alan did with the podcast, what I ultimately did with the podcast as well. Like, you can try to prepare a little. I went out and I did, put a little bit of time and effort into lifting up the production quality and making sure I had good equipment and making sure I had someone that could help edit and make it as pretty as it could be. And I did invest some time and effort. I didn't take a complete blind leap, but there's a point where you just have to move forward and do it and get some feedback and figure out where to adjust. Because if you keep trying to make it perfect forever, you're never going to launch your business. You're never going to launch the new initiative. You're never going to get going.
You'll either never get started or you'll be really sad when you finally launch and you realize you built the wrong product. Because we may have launched XYPN Radio and come to find out, everyone could have wanted to hear from our members leading conversations. I don't know, like maybe the interview format wasn't for them. Maybe they wanted 20-minute episodes. They wanted a 5-minute daily tip instead of a weekly hour-long episode. I don't know, but we could have prepped for, forever and then launched the product or service and realized that's actually not what people wanted. It is one of those, if you're going to jump into the deep end of a pool, know how to swim enough to not drown or at least have a lifeguard nearby. But, you don't have to be an Olympian swimmer to get into a pool, right? And you'll learn. Entrepreneurship is a skill set that you learn. We're not gifted at entrepreneurship. I think some people may be a little better wired for it emotionally and financially. Maybe they're set up a little better, but emotionally, maybe you either have the skill set or you can learn that piece over time. But ultimately, you learn how to be a good entrepreneur, but you're certainly never perfect at it. And no one is born with the gift of entrepreneurship. But so riffing on that, which has absolutely nothing to do with the topic today. So thank you, listeners, for bearing with us. So we were at
this
T3.
moment in entrepreneurship brought to you by.
And we're done. No, and this isn't even a mailbag. So we were at T3 earlier this month in Orange County, Anaheim area. And if you're not familiar, T3 is the leading technology conference. I believe it's Technology Tools for Today.
Advisor technology specifically.
Advisor tech, absolutely. And so they do 2 editions. They do Advisor in the winter or spring timeframe, so February, and then they also do an Enterprise edition. For most listeners, the one in February is definitely the place to go. But we were having an interesting conversation with some folks. I'll give a shout out to Rafe Lee and Missy from SCI because they were having breakfast with us, and they asked us a really interesting question, and I don't think they realized that we were going to talk for over 30 minutes about our answer. So, which naturally leads to a podcast and 2 people that are trying to figure out how to get out of breakfast because they had other meetings. So thank you, Rafe and Missy. So the question that they asked us was, as we're looking at the world of financial planning and the changes that are happening right now in technology specifically, there's been some, TD Ameritrade recently did a very interesting launch with their iRebow sort of marketplace where you can now buy portfolio management directly from the managers through iRebow instead of going through a TAMP. Riskalyze actually sort of launched a similar system, but it's sort of a tack on to their autopilot program, but it's multi-custodial and got some new players out there. And the question we've been wondering and people have been sort of fearful of is fee compression. And so the question that they asked us was, do you see fee compression in financial planning? Is fee compression coming? Which I want to address that, but I want to give it some context for anybody that's not overly familiar. And truth is, I'm not even the most familiar with exactly the history, so I'll rely on you for this. But specifically in the investment management arena, have we experienced fee compression up until this point? And if so, or if not, will it continue or will it start? Just on the assets under management, investment management, separated from financial planning, are we experiencing fee compression that is tangible and something that we should actually be concerned about?
It's a good question. And for those who aren't familiar, I mean, the basic concept of fee compression is just, is competition going to start compressing and taking our fees down? Like, if it's 1% today, it's going to be 0.9% in a couple of years, and then 0.8%, then 0.7%. And are we all going to watch AUM fees go to zero, particularly in a world? And I think there's two things that have really started queuing up this conversation in the landscape. One is mutual funds and ETFs in particular are clearly going through some rather severe rounds of fee compression right now. Basically, it seems to be Vanguard does their thing and then everybody else cuts fees to catch up. And every now and then someone like BlackRock cuts fees a little bit below Vanguard just so they can try to pick up a little bit of market share from Vanguard, but then they're not making any money, which is not good. And so that brutal effect is playing out now in mutual funds and ETFs. And with the arrival of robo-advisors and the infamous, 25 basis point fee for a robo. And in truth, the average fee of a robo is more varied, and many of them today are actually a little higher than 25 bips. But that was the mid-tier fee for Betterment, the upper-end fee for Wealthfront. So that kind of became the number. So there's been all this discussion of, well, if Vanguard's low fees can ultimately cause fee compression collapse in the ETF and spill over in the mutual fund space, does that mean robo-advisors are eventually or inevitably going to lead to fee compression in the world of financial advisors? I've actually been someone that's been pounding the table for quite a few years and saying, no, I don't think it's going to happen. Or at least not that way, not that overtly and directly as though robo competition causes fee compression. There are a couple of reasons for that. The first is, at the end of the day, what robos do is not what advisors do, or at least what robos do is not what good advisors do. I'd written an article about robo advisors, almost 5 years ago. When I went back and researched, I found out it was actually the first article that anybody had published calling Betterment and Wealthfront robo-advisors. I actually got the term from advisor tech guru Bill Winterberg, who said it actually at the T3 conference exactly 5 years ago in 2012. And he had raised this question, are robo-advisors, which I think was a label he gave them a little bit tongue-in-cheek, like Betterment and Wealthfront, who had just announced their business models, are they a threat to financial advisors and fee compression? And that was the question he raised 5 years ago. And I wrote this response article on the blog that kind of became the first one that wrote the robo term out there. And ironically, the title of the article is Why Robo Advisors Are No Threat to Real Advisors. And the whole discussion was that at the end of the day, robo advisors, notwithstanding kind of the advisor label, the more accurate description would really have been a robo asset allocator. Gather information on time horizon and risk tolerance and assign an asset allocated portfolio that matches those parameters. That was what they were built to do. And in particular, that's really something is a solution for self-directed investors. Because, notwithstanding the fact that you kind of quote unquote give the robo advisor the money, you still have to shop for the robo-advisor. You have to figure out which one to use. You have to figure out if at the end of the day you're going to use Betterment or you're going to use Wealthfront, or at the time you're going to use Future Advisor or any of the number of other alternatives out there. And so by the time you go through all that analysis and you figure out which one you're going to use and which one has the right asset allocations and which one matches you, and you're a self-directed investor. And that's fine. But what that means is the robo-allocators were really a tool for self-directed investors to make it easier to automate the asset allocation part, but you still had to do the research analysis and the rest. And that's not who uses a financial advisor, right? Classically, people who use financial advisors are delegators. They say, I don't want to deal with this stuff. I don't want to do it. That's why I'm hiring you to do it for me. And so even when I'd written at the time, I'd said, robo-advisors aren't going to be a threat to real advisors. Robo-advisors are going to primarily be in the competition of self-directed companies like Vanguard and Schwab. And those were the two that I named by label, Vanguard and Schwab. And then sure enough, when we look out 3 or 4 years later, now 5 years later, a couple of interesting things happened. First, 2 major incumbent firms to launch competing quote unquote robo services, Schwab and Vanguard. Vanguard Personal Advisor Services, Schwab Intelligent Portfolios, now expanding Intelligent Advisory. So they saw it, that it was pointed at them, but not at the clients of financial advisors. Now, the second interesting thing that we see when we actually look back at industry benchmarking studies over the past 5 years or so since robo-advisors launched is that the median advisory fee has gone up over the past 5 years. Not down, not even just level. It's up. Now, to be fair, when you drill down a little, there's a couple of interesting effects that have been happening. Number one, the median fee has been going up in upper net worth levels, but it's actually mostly staying even in the mass affluent space. Like the median advisory fee on a $500,000 account has continued to stay at 1%, but the median advisory fee on a $2 million account has actually gone up from about 0.8 to 0.9, which is not a trivial change when you're talking about a $2 million account balance. Like everyone's building an extra $2,000 a year for multi-million dollar accounts, and the fees have actually been drifting up. So, there was this whole dialogue out there about fee compression coming. And when we actually look at advisory fees, or we look at median advisory fees, they're not moving down. They're not moving at all. And if anything, in subsegments, they're moving up.
So the reason I wanted to start with the investment management conversation is because so often we get caught in this, like we say financial planning and yet we mean comprehensive financial planning, but we also mean investment management. And I think that, you and I are on the same page that over time, these two services that have been sort of a single service at most advisory firms, we say we do comprehensive financial planning, investment management, we charge a single fee. We're starting to see sort of a divergence of these fees where folks are starting to separate out the services. We see a lot of people start to do financial planning without doing a lot of investment management, particularly if they're working with clients that don't have assets to manage. They have a new service model. Obviously, that's something we promote. But whenever we talk about fee compression, I think we're looking at two different services, because I think that there's a very good chance that fee compression can happen in the investment management space, but that doesn't necessarily mean it's happening on the financial planning side of the equation.
Very true. There is a subset of advisors out there that I think do face a fee compression risk, a fee compression fear. And it's, if you're charging 1% a year to gather clients into a passive strategic portfolio and just buy an asset allocation of Vanguard funds or even DFA funds, and you go out to them once a year to check in and see how things are going and collect your 1% fee, you have a fee compression problem. You really do. You are now putting yourself in a position where you really are, maybe DFA notwithstanding, you are recreating what a robo-advisor does and charging quadruple the price. And we can talk about
it much less efficiently.
Yes. And we can talk about the value of having a human advisor involved, and notably even Betterment recently launched a plus and premium service that will include access to human financial advisors. But even Betterment's only running it at 40 or 50 bips with a human advisor to check in with you one or several times a year. They're not charging a full percent. They're certainly not charging the more than 1% that I know some advisors are still charging for what are fundamentally asset gathering models. Doing pure, hey, I'm going to get you in an asset allocated portfolio, I think does face some fee compression. And that's a shock for a lot of advisors that have long said, that was my value proposition. Like, anybody can sell you a mutual fund. I give you a diversified asset allocated portfolio. And, since so many advisors struggle to beat on active funds, I'm just going to pick you a high quality series of passive index funds, and we're just going to regularly rebalance. And like, that was their selling proposition against like higher cost active managers. And now they're about to get undercut from a robo advisor that's going to say they do the exact same thing that advisor said they were going to do, but at a quarter of the price.
Yeah. So the takeaway, and we've said this many times on this show, so I hate to be a broken record, but if your primary value add is you build really great low cost ETF models and rebalance quarterly, Betterment and every other robo-advisor out there does it much more efficiently than you do for much cheaper. And it has a much sexier platform that people actually want to use.
You're not going to out-robo a robo-advisor. I mean, if your goal is to figure out how to go head to head with a Silicon Valley venture capital funded firm that's got $100 million of money to blow, figuring out how to get this right with hyper efficiency, like, you're not going to win that battle.
Yeah, not a battle I want to get into, nor is it a battle that most of our listeners are in. But I think it gets confusing because I think sometimes we hear things and we get a little scared and we start thinking like, oh my gosh, is the financial services industry changing so much that financial planners are about to become obsolete? Like, are we about to become the, antenna repairmen of the world, right? And we'll suddenly that's a
peculiar choice of an example to be replaced by robots. Antenna repairman?
It was the fastest thing I come up with. Like literally we got rid of antennas, we moved everything to cable, and now we have terrible customer service from the cable companies.
Not replaced by robots, just rendered obsolete.
Just rendered obsolete. Is the concept of financial planning going away? And I understand that being fearful, especially for younger people that are getting into financial planning or you're looking at starting a business. I wouldn't want to start a business in an industry that we're saying in 3 to 5 years, you're going away, right? So what we are saying is don't start a business doing low-cost ETF models, but financial planning is a whole different ballgame. It's impossible to compare the services provided by the robo-advisors of the past. And so, but we have this sort of new frontier we're going to talk about, but robo-advisors of the past that basically are just really good, efficient allocators, really nice rebalancing softwares is not financial planning. But now we're sort of moving into this new world where suddenly Vanguard and Schwab and now Betterment say they do financial planning. You get access to a certified financial planner. And if I'm not mistaken, pretty much all of them are somewhere between 40 and 50 basis points.
Yeah, or even lower. Betterment has tiers at 40 and 50 basis points, depending on whether you want one-time advice or year-round access to a CFP. Vanguard offers it at 30 basis points, and Schwab Intelligent Advisory technically hasn't fully launched yet, is coming this spring, but they announced they're going to run at 28 basis points, which undoubtedly was simply to be lower than Vanguard.
Just to beat them by 2 basis.
Just to beat them by 2 basis points.
But, so now they claim to do financial planning. So I think this is where we're sort of starting to get this newfound fear of like, okay, well, we were wrong about the robo-advisors, taking over financial planning, but they are sort of commoditizing certain investment management approaches. So is Vanguard about to take over the financial planning world? Are they about to just sort of take over all of our clients? And I have to say, and I can't, I expect listeners to be able to predict our feelings about this. I am so excited about Vanguard Advisor Services. Like, I'm so excited because what they did, in my mind, was they just validated the marketplace. They just validated what we do as a service to a bunch of consumers that have questioned financial planning because we have a long history of not being very good people, right? I mean, we're an extremely distrusted industry, and rightfully so. I mean, we have been taking advantage of clients and selling them crappy life insurance policies that they didn't need and, deferred variable annuities to people that were in their 80s for a long time. And so therefore we got this bad rap, and we're sort of working our way out of this. And as a fee-only fiduciary financial advisor, I've looked at it and said, like, we have an education problem. Like we're struggling to educate consumers on what a real financial planner is. Because when I say, hi, I'm Alan, I'm a financial planner, people go like, crap, he's about to sell me insurance. And yet that it's so different from what we do. And what I think is that Vanguard and Schwab and all these other names, and it in many ways started with LearnVest. I was very excited for LearnVest's model, predicting that it from a profitability standpoint, it wouldn't work. But they went out and just told a bunch of people, this is what real financial planning is, which again, just sort of, I think it's just going to educate a bunch of consumers out there on what we do. But are they going to take all of our clients? Are they going to come in, either take all of our clients or force us to work for $20 or $30 an hour or, financial planning for 20 basis points because, Vanguard does it for 40. So we have to be able to compete with them.
I went on record last year saying I think Vanguard is the single greatest threat to the independent financial advisor today. And I say that only from the perspective of I'm so damn upbeat and excited and bullish on what they're doing. I'm a little scared of what they'll be capable of. I mean, it's been really fun as a financial advisor for the past 10 and 20 years to watch what Vanguard's, low cost mutual oriented model has done to the cost of investing, the cost of mutual funds and ETFs, and watch them just collectively kick the ass of the entire asset management industry to the point now in 2016, Vanguard took in more money than all other asset managers combined, I believe. Ungodly success. But it was fun when they were doing that and we got to use their products. It's a little bit less fun when they come at us directly. And that's the pivot I think that we're seeing. Like Vanguard is going from being an asset manager, whereas financial advisors, we use their funds, into being a financial advisory firm. And they're doing it with, $3.5 trillion of scale and one of the best recognized brands, and still what is fundamentally a company that's organized as a mutual with no profit motive. And so, be careful of competing with anybody that has a multi-trillion-dollar head start and no profit motive if you're a for-profit business. And I think what we're going to see over the next couple of years is that just as Vanguard effectively created the index fund, I think what you're going to see is they're creating the index fund equivalent of financial planning itself. So not the fanciest, most complex financial planning, not the most nuanced thing for specialized situations, right? And in the same manner that, an index fund is, just a passive strategic index fund. It's not personalized, customized, individualized portfolio analysis, and that's adapted for you. I think we're going to see the same thing on the financial planning end. And what that means is a couple of things. Number one, the good news is Vanguard and I think a couple of other companies that are moving in their path, including Schwab and Fidelity, are going to become that missing career track and entry level path for students coming into the profession. And so we'll finally get away from a point where so many people get pulled into financial planning to do what they think is going to be a financial advisor and turns out to be a sales job. And if you sell enough stuff, maybe we'll let you do financial planning later, into jobs that are actually financial planning out of the gate. And as you move up the promotional line at a Vanguard or a Schwab or Fidelity, you'll get to do more sophisticated financial planning and have better salary potential and deeper relationships with the clients and all the things that happen as you move up the line. And so I think that's a huge plus for the profession, tremendous opportunity to expand financial planning for consumers. But what it means for the typical financial advisor is, we've spent our time talking about, well, what are you going to do that's better than a robo at 25 basis points? And I think the challenge actually is you're going to have to answer the question, what do you do that's better than Vanguard's CFPs at 30 basis points? That's the pressure that's coming. And that at least is a little bit closer to a fee compression threat, certainly than the robos were. Now, they're going to do the most complex financial planning, right? You can only go so deep at the price point and frankly scale that they have. The amazing thing from scale is that they can do things really expensively. The bad news about scale is it's really hard to get into specialized niches and unique scenarios. And that becomes the opportunity for us as financial planners building businesses today is, you can either say, what are you going to add? What value are you going to add over and beyond what Vanguard can provide? Or you can go the route to say, who are you going to serve that Vanguard still isn't effectively reaching?
I just envisioned that listeners were sitting on the edge of their seat, wondering when we were going to say the word niche, because that is the direction we're going with this. But I do want to say that you make a really good point about Vanguard hiring students. And I don't want to lose that because it has been one of the struggles when I go and I talk to college classes. And I usually try to talk to 10 to 12 different universities a year. I go give my rah-rah financial planning is an amazing profession sort of speech. But the struggle is they say, well, how do we find a job doing this financial planning that you talk about? Because this doesn't sound like what the Northwestern Mutual sales rep sold us on last week. I mean, they told us we were going to be an entrepreneur and, cold call. And this doesn't sound the same. Like, how do I find what you're looking or, what you're selling, basically? And my answer has always been a little iffy. It's always, I haven't had a good answer. It's like, well, go to FPA chapters, go to NAPFA conferences, go to T3, meet advisors, like try to find an RA that's fee only. And it's a real challenge when, Northwestern Mutual, Merrill Lynch, or any of these companies can show up and basically hire 10 students a year out of every single program, put them through a very nice training program, burn out about 90% of them. And, basically, and the vast majority of those, I think we lose. I don't know what the actual percentages are.
Although it's worth noting, even for some of those companies, I think as Schwab and Vanguard and the rest have success in this, I think you're actually going to see more of a pivot from some of those companies as well. I'll even give Merrill Lynch a shout out credit that they've actually been particularly aggressive in starting to pivot towards team-based models where entry financial advisors come in not to sell out of the gate and go get clients, which is basically what the entry-level gig was for decades and decades, Now they're really trying to put people into 3-year training programs, and you get your CFP and you work as a service advisor on an existing team and you don't have business development responsibilities. That stuff comes later. They're trying to flip it around as well. Some other companies I think are lagging on that a bit more, but that's the opportunity I think of what's coming is we're finally going to see that career track emerge. And it's going to be similar to what it looks like in other established professions. You know, when you get your accounting graduate degree, you come out and then you go work for most people for one of the, now we're down to big 4 accounting firms, and you work there for a couple of years and you get your CPA license, you get your couple of years of experience, and you know, you really learn your profession. And frankly, you kind of work your ass off for not the best pay, but it's a decent professional wage and you really learn your trade. And then a couple of years in, you know, you get to pick your head up a little and look around and say, okay, I'm a legit professional now. I've got my credentials. I got my years of experience. Now what do I want to do with my career? And some people continue to climb the ladder at those big 4 firms. Some break out and work with regional firms and do something more local. And many, you know, go out and hang their own shingle. And, you know, ironically, when I look at it from the XY Planning Network perspective, I'm kind of excited that, you know, my guess is the number one place that we're going to be having new members join us 5 years from now are probably people out of programs at Vanguard and Schwab and those other places that have decided, you know, I've done this for a couple of years and I really enjoy it in the large firm setting, but I want to start my own firm because I've got a particular vision of a particular type of clientele to serve that I don't think my old firm served very well, and I think I can do it.
Yeah, and obviously we're both very excited about this, and it really is because, you know, it's an established career path. It validates that financial planning is a real profession. It's not just insurance sales, but also that, you know, I saw an article yesterday, I think, that Vanguard is looking to hire 1,700 financial advisors right now for their call center because December was this insane month. I'm trying to remember all the numbers, but it was like 350 million of assets flowed over or something. I may be misquoting the numbers, but they are hiring literally thousands of advisors into their call centers because they couldn't handle the call volume. And now, you know, I wouldn't count on Vanguard can't handle the call volume being what holds them back. They're going to figure that piece out. And I will just say I'm very thankful that I am not in charge of the operations and logistics of a call center with that many financial advisors. But you're going to get a really good training. You're going to get a really great education there that you didn't get at the broker-dealers in the past because basically you were put on the street and it was eat what you kill. And you know, most people starved. And now we're sort of relaxing a little bit and doing real financial planning. We're going to get the education that it takes to learn what real financial planning is. You know, and for our young listeners out there, Kitces nor I advocate for, you know, 22-year-olds come out of college and start your own RIA. I don't think that's actually a good idea. You know, and some have done it and been successful. But for the most part, you need it. You need education. You need experience. You need to see what financial planning really is. You need to be on the phone with a client that's experiencing, you know, life and be able to help them and learn how to communicate and honestly put your foot in your mouth a few times because it's going to happen.
Well, and just the reality is when you launch your firm, I mean, there's so much to learn and get through about just how to be a business owner and how to do marketing, how to do business development and how to get your thing off the ground. The last thing you need to be worrying about is how do I actually do financial planning? Because I've never done it before.
It's so true. There's so much to know. That's not the one you want to be concerned about.
Right. Get that experience down working in an advisory firm or in a large firm of some sort. Get that experience under your belt so that a lot of that financial planning work is second nature. And then you can come back to, okay, now that I've been doing it for years and I'm really comfortable with the planning stuff, but I've got a particular vision about how to do it a certain way or for a certain type of clientele, I want to go do that on my own. Now is the time to launch your firm. And that's still why, even as much as XY Planning Network often gets talked about and branded around millennials, you know, the median XYPN member is 37 years old, which actually means you're right on the cusp of end of Gen Y and the younger end of Gen X. And the typical members 37 years old and has about 5 to 10 years of experience in the business already. They worked for a while and they got some experience and they learned their financial planning. And then they decided to take the leap and launch a firm.
So for the advisors out there that are looking at, you know, Vanguard and Schwab and Betterment and wondering like, am I going to be able to compete with them? You know, the truth is they're not, I can tell you the Vanguard model is not built around each advisor having 100 clients that they intimately know, right? It's built around a call center model, and that's great. I'm very excited for it, but I also don't think it really competes with the level and the type. It just doesn't compete with the type of service that we do. And there are so many clients out there that need that more call center style that they can call in, they can ask a question, they can get guidance when they are wondering about investment selection at 403B, or they want to roll over, 401k to an IRA, or they're not sure about Social Security. Like, they can get those questions answered. The questions that require that, honestly, they could go to Google and get an answer for, to be completely frank. And obviously the call center is going to go a little bit deeper than that because it's more individualized, but it's not the same as the type of financial planning that we do. And what I think this is going to do is it's not going to steal all of our clients. It's just going to expand the client base and the percentage of Americans that actually have a financial advisor, whether that's Vanguard. And now Vanguard says that, you can get an advisor that knows your situation, but, we'll sort of see how that pans out.
Yeah. I mean, they're going to be limited in their ability to go very deep on individual advice. I fully expect that they will do what so many firms do already, which is they'll begin to segment, the folks with tens or a few $100,000 maybe into a pooled group at some point, whether it's $500,000 or $1 million or more. You'll probably eventually get assigned over to a dedicated advisor, and Schwab Private Client and other groups have had similar structures for a long time. It does leave room and opportunity for financial planners to work their way in. So, I mean, really what this means is, there's fee compression happening on the pure investment management side. Frankly, there's fee compression happening on the investment management side, for which financial planning is basically the anti-commoditizer, the uncommoditizer, the thing that pulls you out of this, fee compressing investment management model and over to something different. That's a bigger, better value proposition that you can justify a different price point for. And then the secondary effect is happening is, it turns out financial planning is so awesome. We're not the only ones that have figured it out as independent advisors. A couple of large firms are coming in as well, and they're doing it with size and they're doing it with scale, which is, I think, exciting for the profession, exciting for expanding the reach of financial planning to consumers and validating it. And, notably, like for anybody out there who's still on the fence about whether you get to your CFP, you're not even going to be able to get a call center job at Vanguard without a CFP. Their Vanguard personal advisor services are requiring CFPs, and they're putting everyone through it. Schwab's gearing up for the same thing. Fidelity's gearing up for the same thing. So don't think about not getting your CFP. If your greatest risk is figuring out how you demonstrate you've got value over and above, Vanguard personal advisor services, not meeting their minimum job requirements is not a good way to differentiate yourself. So you've got to get there, but then you're going to have to figure out how do you go beyond. So it can be deeper service. It can be, more direct client service. It can just be the smaller numbers, right? Hey, Vanguard's going to have however many, dozens or hundreds of clients per advisor. I'm only going to take 50 or 100 clients and I'm going to stop so I can make sure I can give all of them my individual service. But again, I think ultimately it's going to come back to where do you niche? Where do you specialize? All right. Because Vanguard, because of their size, like they're never going to have a niche in doctors selling their medical practices. You can do that. Only so many doctors, and it's a pretty good liquidity event, and it's a nice business opportunity, but they're never going to go that specialized. And I mean, almost any niche you can come up with, like great niches for advisors where you just got to get your 100 clients or fewer and have a wonderful business. Those are all way too small for Vanguard. I mean, again, they're starting this. The good and bad news is they're starting this with $3.5 trillion under management. So, there's virtually no niche on the planet that's large enough to move their needle. They have to be a mass market solution. And I think they'll actually be pretty good at being a mass market solution. But then your opportunity is don't be a generalist financial planner that puts yourself in a position to compete head to head with Vanguard. That's like saying I do passive strategic diversified portfolios and putting yourself in competition with a robo-advisor.
So if we look at financial planning firms, I think we sort of have different takeaways for larger firms that are growing and are more enterprise level firms. Let's say 100 million and up or 500 million in assets under management up. And then those sort of smaller, maybe more life-centric focused, want to stay solo, 100 clients or less model. So for those big firms, do you see them experiencing fee compression more, or do you see more of a profit margin compression and sort of a need to expand services to their high net worth clients?
Yeah. I mean, you kind of stole my thunder with the question. Yeah, that's exactly how it's playing out in the large firm space. So when you look at the industry benchmarking studies over the past couple of years that I mentioned earlier, the average advisor, or I should say the median advisory fee, and you can actually ask me in a few minutes about average versus median because it matters in this case. Median advisory fee is not dropping, but margins are falling, and actually organic growth rates are falling as well. So there is some stuff that's declining, but it's not the fees. And so here's, I think, the effects that are playing out so far. Particularly if you're a large advisory firm, you look at this and say, okay, robos are charging 25 bips. There's no possible way I can execute my business at 25 bips. So that's off the table. Step 2, I cannot compete with robo advisors on price. How am I going to make my business survive? And so the conclusion that you quickly come to is if robos charge 25 bips for that, I'm going to charge a full 100. I'm going to keep charging my 1%, but I got to do awesome stuff for my clients to really validate why I'm worth more to justify that 1% than what either robos are charging for 25 bips or even now that Vanguard is going to charge for 30 bips. And a large firm effect, what firms end up doing is that means you've got to hire up more financial advisors so you can get the average number of clients per advisor down so that you can go deeper on service levels. You've got to train them all up to be CFPs if they weren't already. If they were CFPs, you probably have to send them out for some, advanced post-CFP designations. So, a CFA or a CPWA or enrolled agent or something else for them to go even deeper. And so as an advisory firm owner, if you got to hire more advisors and then hire more experienced advisors with more credentials, and if they don't have the credentials, send them off to get their credentials, that costs money. So you keep charging you 1%, but it costs you more to deliver the service. It costs you more in staffing. It costs you more in training. It costs you more in team development. And so the end result, you keep charging your 1%, but you watch your margins start to compress. And I think this very directly is why when we look at some of the upper net worth levels, we actually see fees rising because the tandem effect that's happening is firms are reinvesting into their value propositions to try to justify their price point. And then when they get to the end, they actually find out they're actually doing such good stuff. They've got room to raise their prices and still maintain their marketplace. And that's what a lot of them are doing.
So I think so that's sort of the large firm. And I know we have plenty of listeners that are in that area. And I guess before we move on, you said specifically around median and mean. Was that on fees?
Yeah. So the other thing that's worth noting on fees, what the interesting benchmarking data shows is that the median advisory fee is staying level. There's some data to suggest that the average advisory fee is dropping a bit. And it's an important distinction to make because I think what's actually happening and why we see some discussion of the average advisory fee is dropping is because there's a subset of really expensive advisors that are coming down. So like in a simplified case, imagine a world where everybody, there's 100 advisors, 98 of them just charge 1% like everybody else. And then there's 2 dudes out there that have been charging 2% and they're such good salespeople, they've been getting away with it. So the median advisory fee is 1%, but the average advisory fee is higher than 1% because there's a couple of high price advisors out there. Now, as the marketplace gets more and more competitive, consumers get more sophisticated, robo-advisors show up, Vanguard shows up, all the rest of the dynamics. The advisors that used to sell their stuff at 2% say, we just can't do this anymore. We're so far off the marketplace. Consumers have wised up. They're doing Google searches. They're finding out how expensive we are. We got to change our fees to 1%. So when they do that, the median fee still stays at 1%. In fact, now we've consolidated the entire advisor base into the same 1% fee. But the average fee just came down because the average used to be a bunch of 1% and a couple of 2%. Now everybody's at 1. And so that seems to be the effect that's playing out so far is the median advisory fee isn't moving. The bulk of advisors are not cutting their fees in response to RoboThreats and Vanguard and the rest. They're trying to value add their way up, which I think is actually the right decision. But the average fee is slipping at least a little bit because there were a subset of advisors that were much, much higher than 1% that are finally feeling some of the market pressure to at least come in line to the rest of the marketplace. And ironically, DOL fiduciary with its reasonable compensation requirements that you can't be compensated substantially more than others for providing the same service is I think, going to accelerate that process of kind of homogenizing advisory fees hovering around this 1% level.
I have to tell you, as we start to talk about median and mean and how
I just brought you back to like stats class from years ago.
Oh my gosh, graduate statistics. Oh, it's just like, I'm going to be shuddering for days after thinking about that. but anyway,
that was why it matters. That's why you have to know the difference between mean and median.
That's absolutely. I think I actually wrote a blog post about that when I was first starting my blog for Serenity Financial. It was on just like basic statistics because I just got so sick of people that would say things. I'm just like, that's not how that works. So I'm going to, standard deviation and things like that. But anyway, so switching gears a little bit to the smaller firms that are out there and some of the issues that they will face, which I think will be a little different than what the larger firms are facing, because larger firms are trying to maintain that profit margin. They're going to get squeezed, add deeper services, but they're doing it in obviously just a much more broad area. But I think we're going to see some interesting things. One has already happened, and then one is sort of coming, and the one that's coming is having the niche. And I know people get sick of hearing us talk about it. And if you keep listening to this show, you're going to hear the word niche every single episode. And the reason is because we are just slowly and steadily marching towards this world where if you want to compete with the big players, with the big boys like Vanguard, you need a differentiation factor. If you ever come here, Michael and I talk about this topic, we call it the crisis of differentiation. And it's this, and it's our kitschy way of saying that you don't want to go head to head with Vanguard with the same service model. You just don't. I mean, you don't want to go with, you wouldn't want to market against them. So you need to be different. You have to have something that makes you unique, that makes you the best at, what it is that you do. And again, whether that's doctors selling their practices in the next 5 years, or you exclusively work with bass fishermen because you love bass fishing and you have a boat that you take all your prospects out on, I will guarantee you Vanguard does not take people out bass fishing. So if that's your thing, great. That's how you differentiate. But the other piece that I think is very interesting, and I think this surprises a lot of the older advisors, and that is that when they look at our service model, they sort of look at the business model of young planners where we're running these monthly subscriptions, sort of monthly subscription fee for financial planning. As they look at it and they ask this question about like, how do you make any money? Right? We can go through all the math, but 100 clients paying you $150 a month, that is $180,000 in recurring revenue. If you do any assets under management, you bring in some income there, maybe that's another $25,000, $50,000, $100,000 in income. You're bringing in somewhere between $200,000 and $300,000 in revenue at 100 clients. And internal expenses, if you have a part-time or a full-time associate advisor and a few other things, maybe $50,000 to $100,000 at most is going out the door. Probably not even that high. And you're left with, $200,000, $250,000. So when I talk to older planners that say, how are you going to make any money? They sort of look at me, or, they ask this question. I'm like, it's because they've been trained to try to make $500,000 or $1 million a year, and that is success. But when I talk to younger planners, they're like, $200,000. Are you kidding me? Like, I'm happy with 80 as long as I get to work, 20 or 30 hours a week and be able to travel or be able to be with my family more or be able to attend my kid's swim lesson. Like 200 would be like the big dream. I'm happy with 80 to 100. And I think that is going to be the other piece that sort of plays out and just such the major generational difference between the old guard of financial planning as it sort of gets passed to the new guard. And that is that, even if fee compression happens on the planning side, and even if we have to dive into a deep niche and we only get 100 clients that pay us $150 a month, we can still earn a really good living in our minds that maybe, historically wouldn't have been considered quote unquote successful because it's not seven figures.
Yeah, it's long been kind of like a hold my head in my hands and weep a little feeling that the median household income in the U.S. is just over $50,000 a year. So if you only, I'm putting this in air quotes, no one can see, if you only make $150,000 a year and you're an average advisor and a below average business owner, like, it's astonishing how many people in the industry call that failure. You're making 3 times the median household income. in the US. Like only our industry has to call that a failure, that like amazing income for a lifestyle business. I mean, not only are you making $150,000 a year, but you might not even be depending on how affluent your clients are and what they pay you, you might not even be working that many hours. We did a podcast episode, Financial Advisor Success Podcast, a couple of weeks ago, episode 7, a guy named Matthew Jarvis, who is generating about $1 million of revenue. He's probably got a close to 50% profit margin. So you can do the math. The dude has 1.5 staff members and takes 83 days of vacation every year, like 83 business days that he takes off. He actually counts them. It's a key metric for him. And he's 35 years old. So you can build these amazing lifestyle practices with astonishing income levels and never build a big, giant, huge business. You don't have to make some really good money, really, really good money in this industry. Now, granted, you do have to work with some fairly affluent folks. I think Matthew's average client is like $750,000 of assets to get your numbers up that high. But you can make an incredible income in this business simply working with your group of 50 to 100 high quality clients. And again, that's part of why we continue to beat the table so hard on niches. Because, if you want to make a specialized business in underwater basket weavers, like you can go do that. And there's no one to compete against you because, there might only be 50 of them. And once you get them all, you're done.
Yeah, there's just so few industries where you get to do that and then tack on our ridiculously high client retention rates. And that's what makes financial planning such an amazing career, is not only do we have the potential to make a lot of money and to have a lot of flexibility, we tend to not have a lot of client turnover. But the reason we're harping on this sort of or I guess I'm harping on this in conversations with the fee compression, is that even if our fees get compressed somewhat, we're still okay, right? Even if there is a bit of fee compression. But, the big piece is that by separating out financial planning from investment management, we get to allow financial planning to stand on its own value for its price. And I think what you'll find, just did a recent podcast episode with Andre out of Brazil. I mean, he's charging 5% of income and providing that much value that clients continue to pay him. 5% of income. I mean, we're usually recommending 1 to 2%.
I was going to say our rough rule of thumb here that we're finding XYPN members getting traction is if your advisory fees add up to about 1 to 2% of your client's income, it's usually a pretty palatable number for them. So 5%.
5%. And he has 3,000 clients in Brazil. And it's just a remarkable sales and service guy. It's pretty impressive. But even if we look at the 1 to 2%, and we'll just use our rough numbers of $150 a month, that's $1,800 a year. So 1 to 2% means your client is making somewhere between $90,000 and $180,000 a year. There are a boatload of clients that are in that income range that have debt, that have solid incomes, but not necessarily the assets to be able to afford advisory services typically for you to be able to work with. So, I think that's sort of my final piece for advisors, is that one of the things that could cause fee compression is if we had a plethora of advisors. If we just had, if we were graduating sort of like the legal field, right? If we were graduating more advisors than jobs, then we would start to have a problem. But the truth is there's such a shortage of young planners coming into the profession. We have more CFPs retiring, more financial advisors retiring than CFPs that we actually graduate into financial planning, that, there's not going to be a lot, the independent space is not going to cause compression among itself. There's just so much opportunity there that even if Vanguard sort of takes the mass market, what's left is still such a big piece of the pie, and it's not getting split that many ways, that there's still so much opportunity to be able to, again, charge a fee for the value you're providing and not have to worry about what some of these bigger players are doing.
Well, and again, the other piece to recognize as well, I mean, there will be an aspect of fees declining, I think, in the coming years, maybe over the next 10 years. But it's not a competitive fee compression dynamic. It's the awesome thing that happens as all these tools and technology for us get better at running our practices. That a guy like Matthew Jarvis can have 150 clients and support them with like 1.5 staff members and have a successful business, or advisors I know that even do it with with 2 or 3 or 4 support staff members. We have lots of XYPN members that are just running solo with a bunch of awesome technology. And you can do that. And even just 10 years ago, you needed a technology person to run the servers in your office, and you needed a physical office space to put the servers and meet with clients because you couldn't meet with them virtually and nothing was cloud-based. And you just go through the list of all the ways that it used to be so much more expensive to run advisory firms. We support you on compliance with XYPN as part of your $397 a month fee. 15 years ago, you had to join a broker-dealer to do that, and they might have taken 30 to 50% of your revenue back then to be your compliance oversight. Now at least independent broker-dealers, some of them have come down to merely 15 to 25% of your revenue, and maybe even a little bit smaller if you're a big producer. But no one was able to flat fee it before the way that we were able to with XYPN. And that's just all done with the ongoing awesome marching advancement of technology. So at some point down the road, I do think we'll see advisory fees drift lower, but it's not because we're watching our income potential go to zero. It's because as the cost to run the advisory business comes down, as we get better at what we do and better tools, we can afford to charge a little bit less. And that's just the dynamic of how fees come down, right? Like Vanguard didn't charge 3 basis points for an S&P 500 index fund when they launched 40 years ago. They had to keep getting bigger and getting more tools, more technology, more scale, more capabilities, the way that they have, to keep bringing the fees down as the business and the entire industry have scaled up.
So I hope what folks hear when they walk away from this recording is that financial planning is going to be okay. We're going to evolve. We're going to change. But things are going to be okay. We're still going to be able to make a great living. We're still going to be able to run great businesses that help a lot of people. The way that we do that in our operations and our technology, our service model, our fee structure, everything will change, but it changes in every industry. Financial planning has probably been lulled to sleep in the fact that we haven't had to change a lot historically, and we've been very slow to change. And I do think we're going to have to be willing to adapt quicker, pivot a little faster with the coming times. But I think the pivot is, if you're not there yet, our encouragement is to pivot into doing real financial planning and start to develop a focus. Start to develop that niche, start to figure out who you're going to be best at serving so that you can start to more easily differentiate your service model from something like a Vanguard or a Schwab or a Betterment. But we're still going to be here in 10, 15, 20 years. We wouldn't be in this business, I don't think, if we thought this business was going away. We're going to be here for a long time. So, I just wouldn't stress about it. And I do think it's something that folks are stressing about. And I'd rather you just go out and just rock running your business and find something more worthwhile to stress about.
It really is a tremendous opportunity for us going forward. As you said, Alan, companies like Vanguard and Schwab are going to help. They're going to help validate financial planning. They're going to help validate the CFP marks because they're huge companies, and they're going to bring some serious marketing dollars over the next few years to their financial planning offerings, but in the process, supporting all of them, and recognize what a positive spillover effect it can actually be. I did an article last year talking about the growth, or actually the declining growth of robo-advisors and tracking their growth over the past couple of years. And, there's been a lot of discussion that, robo-advisors were doomed as soon as offerings like Schwab and Vanguard showed up to be competition. And the irony, actually, in the short term, the biggest growth months that Betterment and Wealthfront ever had was the month that Schwab Intelligent Portfolios launched. Their best month ever was the month their biggest competitor at the time launched. And the reason is that ultimately it validates the space, and it brings more people in who are interested, and it makes the pie bigger for everyone. And that's the opportunity I think we have as financial planning continues to gain awareness and acceptance, and major firms put major dollars behind it, is they're going to help educate everyone about the value of financial planning and why it's so important to have a financial advisor. And then as consumers go and search for what they want, some of them will pick those services, and some of them will say, I've got different problems. I've got more unique problems. I want a more dedicated advisor. I want a more one-on-one service. I've got particular needs that are unique to me, i.e. I'm searching for someone that fits my niche. And there'll be an opportunity for everybody in that environment. So, if you're still competing with what pure technology does, don't put yourself in competition with a robo-advisor. You're going to lose. But financial planning is the uncommoditizer that gets you away from that. But if you want financial planning to be your own commoditizer, don't pick the most generic, broad-based, generalist version of financial planning, or you're going to put your, like jumping out of the frying pan into the fire. Like you're going to dodge the robo bullet and you're going to get smacked in the face by the Vanguard one.
Well, Michael, thanks so much for being on the show, and hopefully this was helpful for everybody. If you'd like more time to spend with your clients, First Ascent Asset Management can help. First Ascent builds and manages investment portfolios for independent financial advisors and their clients for a flat fee of $500 per account. This industry-first approach to pricing makes professional investment management affordable for everyone without sacrificing quality. First Ascent's 7-member investment committee includes 5 CFAs, a PhD, and a CFP who collectively bring decades of experience, objectivity, and fresh perspectives. First Ascent offers a variety of portfolios designed to produce solid, long-term performance while keeping internal expenses and trading costs low. First Ascent's high-touch service team stands with you as a resource to provide guidance and to make account opening and servicing the accounts easy and hassle-free. They also offer a streamlined technology platform to facilitate proposal generation and paperless account opening. Visit their website at firstascentam.com or give them a call at 720-465-7888. Be sure to join our VIP community at xyplanningnetwork.com/VIP to hang out with other XYPN radio listeners, ask questions for future mailbag episodes with myself and Kitces, and to finally find a community of like-minded financial advisors. Thanks so much for joining me today. We'll see you next time.
You're not alone, and you're not crazy. It's scary starting, building, and growing your own financial planning firm. And that's why we put together a free private community just for you, the Cutting Edge Financial Planner. Go to xyplanningnetwork.com/VIP or text XYPN Radio to 33344 and join a network of thousands ready to change the lives of Gen X and Gen Y clients.